All right, good morning, everybody. Start of a new week. It's like we usually do. We want to start out taking a look at what happened around the world, see if there's anything that stands out. And the way I teach this is that we're looking for anything that substantially stands out, that would be a global event, perhaps something that would last for a long period of time. And the analogy that I use, or the example that I often give, is when that very large ship got stuck in the canal. That was an event that turned out to last for quite a bit of time, and it exacerbated the already uh, interrupted supply chain. Right. So when we're looking through this news, we're really looking for some very large event. And if there's nothing there, then there's just nothing there. There's no reason to try to invent something or to dig deep enough to try to find something that we could quantify as such a thing. We're looking at finance juice. You don't need an account to use finance juice, but I find that it helps. Even just a free account will allow you to filter out some of the things that show up on the list. And one of the things that I look for when I use this is they'll do like a market wrap. They'll do a market wrap from when the Asian market closes. They'll do one for Europe, even though Europe's still open. They'll do one early because they know America's coming online. And then I also use it to see what's on the agenda today. If there's anybody scheduled to speak, they will show up here. Just remember that people can show up to speak that are not scheduled, right? So this is no promise or guarantee that you're not going to miss anything or that you won't be surprised by somebody who comes out to speak. We've seen, for an example, if the market really gets rowdy, the plunge protection team will show up and start chipping their teeth, and then they're not on the schedule, right? So something to keep in mind. Um, this tick strike here on the side, the free version is, I mean, is kind of okay. It will get your attention when when the ticks pick up in the indexes. So if you're someone who's multitasking and perhaps not watching the chart constantly, when this thing starts making noises, it'll get your attention and you're able to pick up the tape speed. Obviously, you get what you pay for. So the one that, if you was to buy it, it works a lot better. All right, from here, we go to Thinkorswim. I like to show this calendar here because if you were to go back and try to do research on an intraday basis, the first thing you could do is bring up the morning briefing from that day. I've been doing these in the public now for over a year, and you could check to see if there was any econ that day that may have affected that intraday chart that you're trying to analyze. If yours is really cluttered, say it looks like this and it's just got a bunch of different things on there, uncheck everything and then just turn on Econo Day event. You can move these columns around. So you set the description next to the time, makes it nice and easy. And as you can see, we've got housing and then we've got additional auctions. We've only got one group of additional auctions. That's the 1130 group. And that's what we want to focus on today. Those additional auctions are very often um, where my midday reversals play out the best, right? So a range day that perhaps wasn't really doing much suddenly turns into a trend day right at 11:30, right when those auctions kick off. All right, so we're looking at the S&P this morning. It's usually where we start. And the logic that we approach with is that the market can really only do three things, right? It can stay sideways, it can expand to the upside, or it can expand to the downside. Before we really get into those expansions, let's just take a moment to go out to a daily chart. I know A lot of newer traders may think that there's nothing on the daily for them because they're intraday day traders, but there's very often valuable information out here. And if you don't look, then you're never going to see it. Maybe you look and you miss it, but at least you tried to look. All right. So, what do we got going on a daily? We've got a TRB this morning, trend line breakover. We are halfway, well, maybe a little less than halfway to the top of the weekly expected move. This is the range for the week. And we're, getting close to about halfway there. We are also back up to the close, not from last week, but from the week before. So that's a weekly close. It kind of ties in with our open, high, low, close logic. So a little bit of a pivot point. Looking at the linear regression line, these swing lows and these swing highs. At the moment, we don't yet have a lower high or a higher high because this current run isn't done yet. We can't call this until it turns and goes the other way. So for the moment, we just have, the previous swings, each one getting lower and lower. So lower highs, equal lows, building a compression here. This is a little homemade indicator. We're trying to gauge how far past the 10-day moving average we are. Every market treats this distance from its 10 differently. So while we know that the 10 is like the center of the basketball court, each market has its own distance from it that it decides is too much. I don't really like the words overbought and oversold, but it would apply in this kind of logic, right? Are we overbought? And the way that I usually use this is more of, have we moved too far too fast, right? Because if we do, then we're looking for like linear regression. We're going to flip over and come back the other direction. Well, in the last few days, we've basically went from 3,700 to 3,900 in the last, if we count this morning, in the last 2.5 days. So that's a pretty significant move. It's a 200-point run. Have we moved too far? Are we overbought? And this indicator says no, we're not overbought. We've got plenty of room to move to the upside. This thing is read in percentage basis, and we're about 1.4% above the 10-day. And the average before we start to pause and turn around and kind of go back the other way is around 3, right? If we were to add up all of these numbers and then divide them by how many times we added them up, we'd get to around 3, maybe 2.75. So there's plenty of room to the upside. And we're talking about how far away from the 10 on a daily chart. We're not overbought at all. This thing has the capacity or the potential to continue to make a significant move. Now, I will point out that when you are looking at swing highs and swing lows, if this has been the trajectory and we're now sitting near the top of the swing, what's more likely? That we break from here and make an even bigger move, invalidating all of the swings that we've had to date, or that we consolidate in this range, we pause, we let the market catch up, and or we pull back again, maybe set a higher low and then give another run to the upside. What's more likely? I would argue that it's very much not likely that we're going to expand significantly above, say, 39.50, because we would be at the top of the swing high. This is kind of the old argument that, when you don't short the hole and you don't try to buy the highs when you're already sitting at the height of a swing. Now, this spot that I just marked, that rally run right there, the distance should have stopped right there. It should have stopped there. It should have rolled over, and it didn't. So it does prove that there are times where it will run to the top side and go even farther than it should after the last swing low to a swing high. So it is possible that we continue this move to the upside past 39.50. We never want to say things like price can't do that. Every time you think price can't do something, it's very likely going to kick you in the face. But approach it from a what's more likely point of view, right? What's more likely that we actually get one of these kind of moves? And remember that this move that I've just circled, that was the March Fed meeting. They announced on the 16th. We had Apple run and almost break records for how many days in a row that it ran. It was an event, right? And it was based on external factors, the Fed chipping their teeth and coming out. So could we break here above 39.50 and continue to go? Yes, but it would very likely need some very large catalyst event to galvanize us into a move like that. Otherwise, 39.64 is the top of the weekly expected move, and that's what we would benchmark this week's move as. Simple enough. So if we get that out of the way, everything else that we work on from here would be pretty basic, pretty simple. So we're looking at a 130-minute, 65-day chart. 39.50 is the number that I've already talked about. Makes the range pretty easy to identify. And since mid-June, this has been our world. I've been ping-ponging back and forth within these levels. If we back it up just a little bit and try to focus on that gap from the 12th or the 10th of June, then we had minor breakouts above that level. And otherwise, we've been maintaining underneath this gap. That gap would be the 3,900 level. So a significant level of resistance. It used to be support. Now it is resistance. That's the way things work, right? So if we were to break above this 3,900 level with conviction, we've still got some old work around 39.40-ish. And if we get above that, then we'll look at the volume profile and kind of lay things out from there. But it's a significant level of resistance. And remember, you would want to draw it with, don't try to pinpoint it to a particular tick, right? The mental image I always try to give people is when you're drawing these lines or these zones or pivot points, don't picture your drawing tool as a sharpened pencil. Think of it as a fat, dull crayon, right? And if you've ever drawn on paper with a big, fat, dull crayon, it leaves a big, fat, wide mark. We're not trying to mark things down to the tick. Instead, we're trying to mark out zones or reaction areas. This box, by the way, has not ended yet. There's no signal that says this is going to end yet. And with FOMC, next week and earnings kicking off this week, we could get what they call a blow off top here in the next few days, which would still be a move to the upside, right? It would just be the last move to the upside before we finally roll over and start heading back down. And make no mistake about it, we're not done with the lows of this year. We haven't set the lowest low of the year yet. We're not done yet. All right, so we want to focus on what we could do today. Well, we already started doing it. One of the things that we could do is break to the upside. And what we'd be breaking out of is yesterday's price action. So we opened gapped up, we closed the gap from being gapped up, and then we've ran all night and we're up 1%. We have an ADR right now of 2.3%. So this thing still has the capacity to move another 1.3, and it wouldn't even be considered an outsized move, right? It would just be like, yep, that's kind of what we expected for the day. So we want to be able to quantify that. How far is a 2.29% move from the close of Friday? Well, that would get us up to 39.67. We'll call it 39.68 because of the change on there, right? So we're talking about getting up very close to that 4,000 region, 39.68 for the upside target today for a normal move to the upside target. Keep that in mind. That would still be considered normal. The way that I work with these and to kind of make it easier for people is we call this lower one half the ADR, and we call the top one the ADR or a full ADR. The reason for that kind of logic is if you think about the way ADR is calculated, right? So from our close on Friday, we have a 2.3% ADR. If you cut that in half, just for some easy numbers, we'll call it 1.15. So from the close, if we were to move 1.15 one direction and 1.15 the other direction, that would give us a 2.3% ADR from red line to red line. But if we were to move 2.3% in a single direction from the close, it would be all the way up to here, right? So two different distinctions in the ADR and how far we would move, half an ADR or a full ADR. At the moment, we haven't even made the half ADR. So on an inside day breakout, it's bullish, obviously. Thanks, Captain Obvious. Got that figured out. As we come into the open, the risk would be that this market wants to attempt to close the gap. So we would be looking for red candles at the open, not because we're bearish, not because we think the market's going to turn around, but because we are gapped up. And when we are gapped up, the first expectation is that, well, we're going to close the gap. I did mention that we closed the gap already in the Globex, but that's not the gap we need to close now. We still need to close the gap from where we opened in Globex last night at the very least, compared to where we're going to open in the RTH session. The easiest way to kind of visualize what that work would look like is if you wanted to study it in better detail, turn off the Globex session. So for an example, we closed here, we opened way down here, and the market ran all the way up and closed that gap. Dun, 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 dun. That's a gap close, just like that. We closed there, we opened there, market ran up, closed the gap. You know, it's almost like we've seen this before, right? So that's how it works. When it doesn't work that way, it actually gives us a lot of information. So on this day, when we closed there and we opened here, and it just slightly attempted to close the gap before running in the other direction, told us a lot about the market that day when it started to expand farther away from the gap. So we've talked about the upside expansion. There really isn't a lot of pivot points to mark out from this level other than, you know, using your measured moves. If we don't sustain this bullish breakout, the next likely scenario is that we stay range bound, and the range would be back inside of yesterday's price action. So from our current location, our zone or our range from today would actually be from our own Globex high all the way down to the Globex low of Friday. That's a very large range, 37.80 all the way up to 39.10. If this is going to be our range for the day, then we would want to break down this range into various zones, right? Kind of take it in quadrants. From the Globex open of last night to the Globex high, that would be a quadrant or a zone. From the open last night to the open of the RTH session on Friday, that could be considered another zone. And each one of those has pivot points that we would use also for benchmarks and validating our levels. Another one would be right before that big economic news we had on Friday. We had a high of Globex. It was shattered, of course, when that econ came out, but we'll use that high up to the RTH high open, and that would give us another quadrant. And then from that high down to the Globex low of Friday, that would give us our other quadrant. So as you can see, we're able to take that range or that zone and break it down into various levels, right? And each one of those would be milestones that, well, when we get there, we expect to see a reaction at a price. We get that reaction. Did it break through or hold? How likely is it that we're going to go to the next level? Blah, 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 right? We just keep carrying forward our, that narrative. That's the word I'm looking for. Keep carrying forward that narrative. So with that in mind, it would be 38.78, 38.40, 38.11, which is a cog line, and then 37.80. So simple, easy, nothing to it. What happens if we actually turn bearish from this elevated position? We would need to break through all of these zones and levels that we've already talked about, and we would be looking for a downside break below 37.80. Could we actually do that today? And yes, we can. The ADR right now is 37.90, which would be this yellow line that I'm circling. Remember that a fall to that distance would be normal. It wouldn't be an outsized move. It wouldn't be a big move. It wouldn't be an extreme move. It would just be, yeah, that's the ADR for the day. We were expected to travel at least that far. We're talking about a market falling all the way down to 37.90 from our current location today, and then still saying, oh yeah, there's plenty of room to go from here, because the ADR is normal. And when we have an outsized day beyond normal, then we would take that ADR and we would add yet again another 50% to that. So we'd be looking at like 3.5 basically. If we were to turn negative, by the way, it wouldn't be sneaky. It wouldn't be subtle. If we were going to make moves like that, everything would light up. We'd have a very correlated market, say 95 or 97 names all moving to the downside, no sectors positive, tick pushing into minus 1,000 constantly, not crossing the zero line, holding above or holding below the -5. C ticks would be pointed straight down. You wouldn't have finance, you wouldn't have tech, heck, you wouldn't have any of the sectors, right? Maybe energy, but everything else would be down. You'd have a dollar ripping to the upside as well. The dollar would be up, the VIX would be up, right? So it won't be subtle. It's not going to sneak past you. All right, we're looking at a 10-day, 30-minute volume profile and a TPO, time price opportunity profile. 3,900 round number. We got 39.11 to the upside. There's no volume up there, right? So we can look left and we can mark a pivot point from, say, Friday the 8th, a few weeks ago. We can mark that pivot out just because it was the high of that day, but there's no volume up there that we would mark or point to and say that there was some sort of resistance. We are getting into some resistance right where we're at. And whether we're above it or below it, I'd say we're tangled up in it right now. Right at that 3,900 level, we can see a significant level of volume there. That can often act as a little bit of support or a little bit of resistance. Never lean on that thing like it's some kind of handrail that you can trust, right? It's just very active. It's a reactive spot in the market. We expect there to be some consolidation or a struggle. Basically, what we're seeing in price this morning is a great example of what we would anticipate. Market ran to the upside unobstructed, right? And then it ran into a large volume node or a large volume zone, and it's now struggling to resolve that zone. We are outside of the box, by the way, and when we're at the bottom of the box, we expect to go up. When we're at the top of the box, we expect to go down. And when we are outside of the box, well, we expect to come back into the box. It doesn't owe us that, right? It could continue to go to the upside. Just it would stand out if it did, right? It already took a significant amount of push to get us to expand beyond the box, and it would need that continuous nonstop push to keep us outside of the box. If we don't get that, we're going to come back down again. Um, yeah, Michael, I always do, right? I always do use weekly levels, and when it comes to virgin points of control, I mean, I look at them and I mark them off, which we'll be getting to here in a moment. But a lot of the times we don't have one, right? And even if we don't have one, then it's like, well, what are we going to do now? I'll focus on things like the weekly expected move and pivots such as open, high, low, close, and not be overly concerned with a virgin point of control or the lack of a virgin point of control. We've still got plenty of things that we can focus on without having that POC or VPOC. Having said that, we do have a VPOC underneath this 3856. You got to think about where that ADR is. 3856 would be within this quadrant here. And our half of an ADR is below that, and our full ADR is well below that. I've often argued, well, not argued, just so if you take these volume profiles, this day-to-day volume profile, and you were to go study volume profiles, what they teach is that we should carry these forward, right? That today's is okay and it has some value, right? But yesterday's has more value. That's the way they teach it, right? Yeah, untapped, virgin, naked, couple of different ways to say it, right? Has not, untapped, great way to say it. Untapped, untouched. So if you were to go in and you were to study volume profile, they say that yesterday's really has more value to us than today's does. And I can definitely agree with that. But then it says we'll carry these forward. I mean, I'm not against it, but I've already got so many valuable pivot points. And most of the times, the ones that I would carry forward were already something that I would already be looking at. Like this value area high is Friday's high. Well, I would already carry forward Friday's high. So I would have my line brought forward, not because it was the value area high, but because it was Friday's high. But the fact that I can say it's both makes me like that line even better, right? And that's where we talk about confluence. If we can do technical analysis from three different perspectives and we still get the same answer, that's awesome, right? What we want to avoid is things like multi-collinearity. Then that's where maybe you look at 9 different studies or 9 different indicators or 9 bits of data, but those data bits were all derived from one thing, like volume or price or something like that. Stockcharts.com has an entire article wrote about multi-collinearity and how we should break our indicators down into different sectors or different quadrants. I guess I don't have a good word for it. But notice here on Thinkorswim, for an example, you've got upper studies, trendline studies, momentum, trend. Well, that's the way stockcharts.com breaks it out. They say, okay, you should have a volume indicator and you should have a trend indicator and you should have a momentum indicator. And that way, if you wanted to be the kind of person who looked at multiple indicators, that at least each one of those was looking at something different instead of having 5 indicators all from trend or 5 indicators all from volatility, because then you're going to get into multi-collinearity, which is basically like an echo chamber. So we've talked about the downside move, the upside move, the range bound move. Let's take a look at what's going on in the other markets. That dollar destruction has been phenomenal for this run this morning. We want to continue to see this. If we're going to see a rally in the S&P and the NASDAQ, that dollar's got to get back down. And, even the fact that it's still at 107 right now is really shocking, right? And the target in the dollar for the year is still 120. I'm not taking that off the table. We're just not going to 120 this week, likely, right? Very likely we're not going to 120 this week. But we want to continue to see that dollar sell off. I'd rather not see it sell off in exaggerated sweeping fashion. Nice and calm and easy swing highs and swing lows, no massive liquidation breaks, right? That's not the kind of market we want. So a nice gentle fade in the dollar would be a good thing. We continue to see that dollar fade off. We can continue to anticipate a move in the upside with the S&P and the NASDAQ. Due to linear regression, dot plot statistics, mean reversion, the dollar is very likely not going to continue to move in the same direction all day, right? It's very likely going to pause and consolidate. And the rub here is if it starts to base and consolidate, it very likely could cause our market, the S&P and the NASDAQ, to also pause in that advance and begin to become range bound and consolidate. All right, so kind of keep your eye on that. It doesn't have to, by the way. The dollar is not an inverse product like a teeter-totter, right? One goes up, one goes down. It's not like that. It's more of, is this thing putting pressure on our market or not? And if it starts to put negative pressure on our market, it makes it harder for our market. With that in mind, keep your eye on the bonds and keep your eye on oil. We did get that gap close last night in oil, which is beautiful, but that's all we got out of it, right? And it started to fade back off again. Right now, I'm more focused on that first candle, that what we call the initial balance. The first 1 hour of Globex sets the range. I'm looking to see if we're going to come back down into that range or not. That's kind of my benchmark. There is a micro oil that you can trade, by the way, MCL. And if you don't want to trade that, then you can also lean into something like Tasty Trades or Tasty Works with those new smalls exchange. But those things are so awesome when it comes to trading in the futures, especially from a swing trader's point of view, right? I love trading the futures, but I'm not always really interested in swing trading something like the ES or the MES. It's just too big, right? When you go and you trade something like the smalls exchange, even a small account can do that. And you don't have that elevated margin in the overnight hours. Demand destruction in the dollar is helping us out. And at the moment, they're not using energy as a weapon against the market. Keep your eye on that, though. We start seeing that dollar uh, bidding back up, or we start to see oil get back above $100. We're going to start to see that pressure again in the S&P and the NASDAQ. Look for the VIX to confirm, but I mean, this thing's been a sorry dog all year, and I would be surprised if it actually wants to help us at this point. Still, you never know. You can often get a little something out of it. Like Friday, we started to get that confirmation of the move. At least we were looking for that confirmation, and it gave us a little bit of a movement, right? I was throwing it on Friday that our benchmarks were below 26, and then it was below 25. And if we could get below that, we'd have a nice rally. Things were working out pretty good, but then we just stalled, and that thing couldn't get below 25. If you look at what it's been doing all night, nothing. Right? It's a whole lot of nothing. And now we finally got a little bit more out of it, but basically nothing. The best we can say at this point is we're below 25, just by a penny. It needs to maintain these low levels. For my benchmark right now, I would call it 25 half, maybe 26. We start to see the VIX above that. There's not going to be a rally in the S&P and the NASDAQ. If this thing gets below 24 or say 23 half, we're very likely going to get one of those bear market rallies that everybody keeps talking about. Keep in mind, we do have the Fed next week. They're going to go into silent mode soon. And that doesn't mean that nobody can come out and talk. We've seen Fed speakers come out, non-voting members, right? There's the voting Fed members, and then there's non-voting Fed members. Non-voting members can come out if they have to. We've seen that. And then you still got people like Yellen. She's not constrained by that silent mode. She can come out too, and she's the one that punched this dollar in the face the other day, right? You can say thank you, Yellen, for this little move that we had last week with that beat down in the dollar. That was her. So uh, I'm no fan of hers, in the grand scheme of things, but I do like me a little bit of a rally. All right, so we're looking at TradingView this morning. We got the S&P 500, but honestly, I don't want to look at 500 names, right? So after we set this to pre-market change percent, we want to drop this down to around 100 names. You don't have to get it perfect, and I can tell you it's pretty hard to hit this thing right at 100 names. Just kind of get close, right? Uh, Oftentimes, the market cap will be for a group of names all at once. So if I try to wiggle this one way or the other, I'm going to go and overshoot it by about 18 names, or I'm going to come up short by about 7 names. Close enough to 100, right? Don't stress on it. The next thing is all this gray area, right? All this gray. Well, we can eliminate that, right? We can kind of help improve the visual a little bit. Just change the multiplier up at the top. So now we've got the S&P 500 filtered down to about 100 names, and we've adjusted it for pre-market changes, and we can see that we're in a risk-on situation, right? There are still quite a few gray boxes, and those gray boxes imply that the market hasn't made at least, I think it's a tenth of a percent is when it would start to change. So these are the names that are basically flat this morning. See if we can adjust this just a little bit. Extended hours. There we go. The S&P 100 in my watch list, I don't know why they'll let us do that, and yet they won't let us run a heat map on the S&P 100. Some things about this tool that I don't like. Anyways, what we're looking at this morning, you got to ignore the Google thing, right? It's split, so it's not down 94.94%. It was just the split. And that's the last one, right? That was the last of the big dogs. There are no more big dogs. And it was good to see that it finally did get it done, because I was looking at cap over the weekend, and Google's like, it was like 27, and there's two Googles, right? There's Google with the L and then Google without the L. And when you put those together, we were looking at like 52 in the market cap versus things that were like 2 in a market cap, right? And of course, I'm leaving off a bunch of zeros on the other side. I find it easier to talk about things when you just drop the zeros, but consider that, right? Think about how big Google was and it was the last one. Everything else had already split. Nothing else was that big, and it was just Google. And it had an outsized weight in things like the NASDAQ, which is calculated in a way that the biggest names make the biggest impact. Now that it has split, of course, we'll probably have to wait until the end of the day. Yeah, see, it's still showing really big. When you put that in perspective, you look at Google sitting at 27, and the nearest closest name past that would be Apple at 2. So, we get the split, we let this thing settle out, and now we won't get that outsized weight anymore. Yay. When we're looking at the names this morning, we're really looking for things like a correlated market state, high correlated coefficient. So in 95, 97 names, we can do something like an alpha protocol and just buy every name on our list, right? Remember, you have to set your own protocol list up. But why cherry pick 1 or 2 names if 99 or 98 names in the entire index are all running? Every name on the list is a buying opportunity, right? Short duration, in, out, something like a 45 to a 52 delta Option side, just you're in, you run it. And for the one or two that doesn't play with the group, they stand out like a sore thumb because they're the only thing not moving with the rest of the group. You kill those trades quick and let the rest flourish. We haven't had a chance to really do a alpha protocol play, right? And then that's kind of what we want, right? We don't want to have days like that back to back to back to back to back. Earnings season kicked off last week. Financials were a part of the move Friday. So far, everything is fine, but be on the lookout for, just like I mentioned last week, for one of those banks to come out and lower our year-to-date or year-end forecasts. We've seen Friday that they were lowering China's year-end forecast. They start to do that in our market, and we're going to see some real ramifications from that, right? So it's not just that they're reporting earnings. It's also the idea that during this earnings report, they will often add their perspective or their view, right? And they'll give that forward guidance on the rest of the market. Now, there is always the argument that we could have our bottom now, because remember, we don't want to say things like, well, price can't do something. Could this bottom that we've had be the bottom? Yeah, I mean, it could. I don't believe it. I don't think we're done yet. Earnings season, we haven't even started to feel the pain yet. And we've been able to devalue everything except this. Right? This is the last thing on the list. We got to devalue earnings. They've run amok, right? The PEs, the numbers, they're insane. We have to get that number down. It's demand destruction 101. We have to see this number come down. And then what are they going to do to get it? Well, I mean, we're going to see it unfold. Right? It's a part of that macro to micro perspective. We've had demand destruction everywhere else. We've got to get this destruction into, get these numbers down to a more realistic repricing, right? So for today, focus on individual sectors. There's no particular sector looking at this grid that stands out as a hotbed. It's usually a quick glance. We just bring it up. We look at it. We're looking for anything that stands out that goes opposite of the crowd. We're bid up this morning. Is there anything that's really negative or flat? And the financials stand out a little bit, but other than that, health technology, right? There's nothing really here, but that's okay. We don't want to put something there just to be able to say, oh yeah, look what I found. Now, quick glance, you look at it, nothing stands out, and we kind of move on, right? So here's the NASDAQ 100 pre-market change percent. We don't need a filter because it's already 100 names, but we could change that multiplier to maybe get some of these gray ones to pop. We didn't, but it was worth a try. Non-durable consumer, maybe a little bit of retail. I always like to get a perspective for how bullish or how bearish, and we can do that by counting the numbers, right? So how many names in, say, the S&P 100, how many names are up at least 1% this morning? 35. Well, that's not really bullish, right? Are we up this morning? Sure, we're up. But by breadth, we're not up by very much, right? If we were up a lot, then we'd have, say, 45, 55, even 60 names that are up at least 1% this morning, and we don't have that. We've got 35 names in the S&P 100 that are up at least 1%. So let's just kind of back that number off and say, well, how many names are up at least a half of a percent? 60. Now that's a good number. 60 names out of 100 are up at least a half of a percent this morning. That's a nice gapped up market across the board. If we were to roll over this morning, all of these names that are gapped up at least a half of a percent, they're going to be the ones to target, right? And then, maybe the higher beta names, something that fits your stomach for risk, fits your account size. Google was the last stronghold, right? Now that Google is gone, very likely the most costly options that you could trade is probably Tesla. Man, those things are just crazy expensive. Remember that there are no financials in the NASDAQ 100, and we're seeing a lot of financial names in this list that are up at least a half of a percent this morning. So this is the S&P side of things. Let's flip it over and look at the NASDAQ. How many names in the NASDAQ are up at least at least 1%? 45. Now, that's a good number. We're very close to 50% of the NASDAQ being up this morning, at least 1%. That's that's a really good start. This tells us right off the bat that it's more on the technology side this morning than it is on finance. Remember, Friday it was all finance. Finance ripped to the freaking moon, and the market just couldn't fight it. And every place that you thought we were going to flip and fall back down Friday, we didn't because of finance, right? And it even brought tech in kicking and streaming Friday, but that's where it was all from. Right now, we want to see which one is going to be the player today, and or which one's going to fall out of bed. You can see, looking at Friday, technology. I mean, every time we ripped across that VWAP, the S&P and the Nasdaq was another play, right? But the main one was finance, and a lot of times I use KRE for this, regional banks, rather than just the broad brushstroke of XLF. But we just kept expanding farther and farther and farther and farther, and this was every reason why we didn't dump Friday with the S&P and the Nasdaq. And then that ripping run into the close, tech came in. And now it looks like we're getting that sustainable carryover this morning in tech, right? And of course, if we go and look at something, the ES is up, 0.75%. The NASDAQ is up 1%. Now, granted, it's starting to fade off a bit, but it was up even more this morning. It was up nearly 1.5% in total this morning, near that, before we started fading off. Now we're getting that little liquidation break. And by the way, it never closed the gap last night. It got close, but it didn't close that gap. Absolutely. So somebody on the YouTube stream said he supposes that we could just maintain the range, and that's absolutely true. Remember, the price doesn't owe us a direction, right? It could just maintain for a large part of the year right down here at these lows. It absolutely could do that, right? And if you were to go back to, say, the 0708 housing crisis, or the dot-com bubble, go back in time to where there was a negative market, not just flash crashes and market downturns that the Fed was able to flip over by printing a bunch of money and pushing us back to the upside. Not those kind of pullbacks in the market, but actual real global economic impact that pushed our market down, and how long it took in that basing pattern before we started to come back out of it again. All those call the bottoms and V bottom lows that we've had in the last, say, 10 years. Well, the reason they look like a V bottom is because the Fed stepped in, playing the hero and the savior, right? And pushing us back up out of those. Well, they can't do that this time. They don't have that tool at their disposal. So, you start looking at something like this in that basing pattern, it starts to make a little bit of sense, right? Because they can't fix it this time. All right, everybody. It is my day to stream. I will be in stocks and options channel at around 9:15, and we will get started. Should be a pretty good day. Look forward to seeing y'all there.